very good evening to all the participants. We will try and address a few portfolio changes, a few philosophical, tactical shift that we have done, and also what are we looking at the markets going forward. So over the past 6 months, we have seen a witness, a fundamental shift in how the markets are pricing risk and opportunity. The traditional narrative that larger, more stable companies are safer are being challenged. And for discerning investors, this presents one of the most compelling mid-cap opportunities we have seen in several years. Today, we will not even share the portfolio, but also philosophy or how to how to look at the market going forward. That's rewarding fundamentals over sentiment, rewarding quality over momentum, and rewarding longevity over the near-term growth is what our clear focus is. So let's explore what's changed and how it's the time to act. So we think market is an inflection point or an opportunity is very critical rather than thinking about what's happening in the next month and the next quarter and so on and so forth. Looking at here, you can clearly see divergent performance in the market. The market is clearly speaking. The question is, are we listening? Look at what the market told us this calendar year. It's not a uniform story. On the factor side, value surged nearly 12 to 13%. Low volatility obviously gained 7 to 8%, but the quality delivered merely 3% this particular year. When you look at the index side, Nifty delivered nearly 9% return. Mid caps were hardly 3 to 4%. And the small cap actually declined this year by 7%. That's a very, very wide divergence. This divergence is critical. It obviously revealed two things. One, size is no longer a proxy for returns. And two, if you have a generic exposure, the returns will not be obviously very uniform. To give you a perspective, despite Nifty delivering 9% return, the median return for the Nifty is actually very, very minuscule, and the median return of the company is struggling. So my limited point of discussion here is the mid cap index, despite a 5% return, which is lower than the large cap or Nifty returns, you would see, the most of the companies are actually grinding through difficult conditions, not because of anything particular reason, but only because of several companies, having a bottom up opportunity for next particular year, and they're building on strong positioning that they had, already built up last year. So, in my understanding, divergence in the market has created opportunity, and broader index level returns are hiding underlying weaknesses. So we think the clear focus on the market for next particular year will be bottom up selection rather than thinking about broader index level return, and that's the key message I want to leave you with. Moving to the next slide, clearly that's also reflected in the liquidity. So if you look at the liquidity, which is obviously one of the barometer of what the interest of the investor in the market, not only have we seen a 15 to 20% cut in the liquidity in that Nifty, which is obviously the top 50 company in the country, but as we progressively move towards the mid and the small cap, the mid caps have seen a 50% cut if you look at from our September 24 levels, and the small cap have seen a one-third cut in the liquidity. So what we basically measure liquidity here by clearly average daily value being traded. So what I'm trying to just suggest here is the journey has been tough, led by both the broader level earnings being moderated in certain categories, be liquidity sort of getting more and more contracted, and see the returns obviously being a little lower thanks to certain pockets of higher valuation last particular year. Moving ahead, we think that's the big message here is X of commodities, the earning growth is actually very, very minuscule. If you look at the earnings growth, FY26 earning downward has been brutal. In fact, December 24, we saw 3% cut in earnings for 500 companies. As we keep proceeding further every quarter and quarter, the expectation have been reset. Now, what matters the most is a large part of the fiscal year 26 first half earnings has led by commodities and metals, thanks to the voracious rally that we saw in gold and silver. The market is, already pricing a 10-12% growth in narrative, but the data only suggests 3% growth. So what we are trying to say is, there's not a small gap, but a very big gap between what the market is thinking and what the numbers are delivering. So in this context, we need companies where management not only does not have a very strong pricing power, but also have a very, very strong defensible business wherever capital allocation is disciplined and where the cash generation is visible. That's exactly where the good and clean portfolio will differentiate compared to other portfolios that you will invest in. Moving ahead, if you look at the earnings growth, as I said, right, it's completely skewed. If you look at the commodity, barring commodities, earning growth has been nearly 3% for the first half. And I will not be surprised that the Q3 numbers that we are sitting already at will also be skewed because of the voracious rally in the metals and the base commodities in the country. So when you look at a full picture of FY26 earnings, the core businesses, whether it's consumption, barring auto and auto ancillary, a lot of these sectors will have a difficult financial year in terms of earnings. And in commodity related, rally has been the key sort of, I would say, driver of earnings in FY26, which we don't see usually has not repeated on back to back sort of years, unless there's a global phenomenal growth that we saw in 2003 to 7, or there is a releveraging cycle which we have seen in global markets in the previous decade. So we think the real message here is core business earnings are relatively muted. Commodity driven earnings may not necessarily sustain, which is why bottom up stock picking becomes all the more prevalent and critical for somebody to invest in a portfolio that can withstand such kind of volatility going ahead. Moving ahead, this is a portfolio we have sort of aligned now, given the backdrop and the context we just shared. So we have seen, right, how the portfolio how the market has been quite tough, both in terms of earnings, liquidity, in terms of valuations. Now, in that context, our investment philosophy is fairly simple. We should be timeless and not trendy. Before we walk you through the portfolio, I want to articulate we are not doing just mid cap, but we are obviously doing, wherever earnings are actually, getting delivered or wherever we think inflection points are coming up. So our strategy is basically, driven on 3 to 4 pillars. And we think clearly, we are not focusing on sector rotation or macro overlays. We're just thinking from where the business, will stand from 3 to 5 years. We are thinking from, what are the unit economics of the business, what is the capital efficiency, and what is the strategic positioning that the business is going through. So, which is why first and the foremost portfolio strategy of bottom approach is a core important, you know, core important allocation for the portfolio. So not only are we investing in high quality companies with proven business models, but we think clearly market is mispricing the opportunity in these businesses from a next 2 to 3 year perspective. And we think this rigors will pay off not only in down markets, but as in we see, the earnings of these companies start getting delivered in FY26, second half and FY27, you will start seeing, the market rewarding these companies by a clearly big winners. The second big pillar of the portfolio is now the value and growth arbitrage. So we, in my opinion and many years of experience, the market, usually love three things: consistency, scalability, and predictability. So mid caps, have all the mid caps having all three is very rare. Most mid caps have two, which is consistency and to some extent scalability. But predictability is the biggest obviously question that most mid caps sort of lack. And that's exactly where we are the opportunity is we are finding businesses that are not only delivering at 15 to 20% growth, but also available in a 1.3, 1.4 times PEG ratio, which is why we think the value and the growth arbitrage is a very important, matrices that we will be focusing on. So these are the companies that will deliver at least 1.5 to 2 times the broader index expectation in earnings and available, at I would say, if not extremely cheap, but very attractive valuations of 1.2, 1.3 times PEG. The importance of, attractive and relatively, very strong valuation is it, gives you marginal safety plus upside optionality, which is why this particular pillar of value versus growth arbitrage is very critical for the portfolio strategy going forward. The third and the important point and the third important pillar of the strategy is inflection point. So we think, if you think about, most credit cycles, capex cycles, policy cycles, all these companies exposed to these, macro variables will have deep cyclicality or, very, very strong structural bets, but essentially will go through one or the cycle. Whether in some businesses, those cycles typically last 2 years. In some businesses, it lasts 3 to 5 years. What we are trying to position here is the companies who have already done enough capex, the companies who have already received enough orders, and the companies who are at the inflection point are the businesses that we are trying to bet on these businesses. Now, right now, I'll give you example, right? For example, financial as a segmentation, automobiles as a segmentation, uh, to some extent, ferrous metals, to some extent, thermal proxies. These are the businesses who have, had a very long history of building capacities, building capabilities. And now we think of the next couple of years, they will see an inflection point of both the revenue getting executed, the order book getting executed, and subsequently the margins flowing through the profit and loss, and particularly leading to higher earning growth. In that context, we think this, pillar of the strategy will not only drive earning growth, but also in some cases will drive re-rating and essentially leading to performance of the fund. The fourth pillar, and by no means the last one, is the new age, sort of companies or new age technology companies. So, technology obviously is not new anymore. We obviously have seen the way technology has been a big, big boon for a lot of investors as well as consumers. But the distribution shift, consumption evolution, services, these are obviously changed the way you and me, you know, consume or a product or services. So we have identified some companies that doesn't even do well in the near term, but also have structural tailwinds. They might sound unfamiliar names, but the market potential for these businesses are very, very huge. And why does it matter? Just to think about it, if you look at the broader market and the broader, sort of opportunity is massive, but the organic growth in most markets in the country because of hyper competition is limited. So, in order to disproportionately grow, you need to either have disproportionate technological advantage or you need a very, very broad based platform for people to come and sort of trade on that particular platform, either being services or products. That will not only lead to the growth being multifold compared to traditional businesses, but also lead to profitability accelerating, because eventually that's an operating leverage business that we sort of see through. So the so in order to summarize, the way we are thinking is it's a systematic disciplined approach of investing. Each pillar solves a market inefficiency opportunity, compounding advantage from differentiation. And we think broadly, in most cases, we will be very wary of what kind of valuations do we pay for this particular earnings growth. So we think we do not want to chase narratives. We will obviously chase numbers. Growth will remain elusive for a large part of the market going forward as well, and we will find growth at reasonable value, because only value investing may test a lot of patience, which in my opinion needs 3 to 5 years investing, which essentially again not a broader cup of tea for a lot of investors. So this is a point that I want to highlight. Now, just to give you a perspective on how are we thinking in sector allocation in this context. As I said, right, we are not doing a top-down approach of investing. We are thinking of bottom-up approach of where we are finding enough and reasonable evidence of what's happening on the ground. Now, why are we shifting capital is the first question. Portfolio strategy is obviously has no meaning without execution. So financials is one of the largest move we have taken in the portfolio, up from nearly 25-26% to now nearly 38-39%. So, we think there are two, three very critical perspective. One, the liquidity has moved up tremendously in the last 4 5 sort of months or so. B, the RBI is clearly in dovish mode. C, inflation is moderating. And D, credit growth will only accelerate in the second half of FY26 and will further accelerate in FY27. In that context, banks will not only expand margins in FY27, but also, will be a beneficiary of credit growth acceleration. Don't forget, NBFC will also participate and enjoy the party going forward. More importantly, at valuations of 15 to 17 times multiple price to earning, and in most cases around below 2 times price to book, financial offers the best risk reward in the market. So we are saying that position sizing in the financials is obviously a corollary of a lot of things. Growth in acceleration, credit growth, RBI dovish mode, inflation coming clearly coming in the favor of the further rate cut, which we think can potentially happen as we proceed into the remainder of the year. The second and the most important bucket that we moved further was automobiles. So after we clearly saw what happened in GST, right? GST, one of the most, I would say, one of the best move by the government in the last 15 years is moderating tax outgo for a common man in automobiles. Automobiles obviously were taxed between 28 to 42%. That obviously has come down by 10 percentage points by a single move announced by the Government of India. This benefit across the OEMs and ancillaries. Additionally, the capex cycle has just picked up. All the top OEMs has not only expanded capacities but obviously are committing for more capacities to tap both domestic as well as export market. So we think the earning growth for the sector will only accelerate in FY27 because the full effect we'll see in next year after a very, very brief and lull FY22, 23, 24 numbers for the sector as a whole. So we are taking a very calculated approach that the volume growth will not only resume but accelerate in FY27, which is why the allocation has gone up tremendously. The the next big shift I would say is between allocation of industrials. So industrials, as I said, right, companies with large order books, companies with significant sort of revenue visibility, and companies with a lot of capex that will get commissioned in the next 3 years are the ones will be clearly beneficiary. And we're not taking a broader capex cycle revival story here. We are clearly looking at bottom-up ideas that will deliver industry leading growth, but also will not be dependent on external factors or news like whether the government put in capex or whether the government retracts capex in the budget coming in the upcoming budget. Where have we taken money off the bit? Where have we taken money off the table from? Pursuing consumer discretionary. So consumer discretionary was a very, very fantastic, I would say, driver for the fund, for the portfolio, sorry, last year. And, we think the earnings saw massive misses in this particular year, not because of the fact that the consumption is slowing down, but because of the fact that there were unseasonal rains in some cases, there were market expectations beyond the company's deliverable, and some moderation in the growth numbers versus the broader market estimates were. So obviously, as we as we do our dipstick survey, as we proceed on doing our channel checks, we saw that the earnings growth, or let's say the demand recovery, continues to be postponed. And we think it's still 6 to 9 months away from meaningful growth visible in this particular discretionary sector. So we think unless we see a very, very strong visibility in demand recovery, we will maintain lower exposure in this sector. And this is exactly where the market, says very bullish. But we think the data argues for very big caution in this particular sector. In chemicals, China continues It's, is strength on putting pressure on the realization. US tariff uncertainty is a big headwind for both chemicals and pharma. Both are businesses that are quality. Both are businesses that are making some in a down cycle also, return on capital is quite reasonable. But we think, it's not being about the right and the business, but we think it's also very critical that the broader demand, both in export market, should support such businesses. So we think we are, we are moving the portfolio basis on strong data, strong insights. We are not doing cycle positioning that, something looks good from a next 3 or 6 month point of view. And we are clearly focusing on quality deals within each sectors. And we think active management, will add a lot of value to this, because the question that we will obviously see is, are we planning to, sort of look through the prism of near-term volatility because the next year growth will be sharper in the sector that we allocated? The answer is yes. And we will probably go on to say that the earning growth in the consumer basket will see a disappointment as we see the end of Q3 and Q4, because either the consumer is upgrading, which is premiumization, in a lot of listed companies are not a part of it, or the consumer is spending, in businesses that is not been captured from a Indian manufacturer point of view. So that's the way, we have seen a sectoral shift in positioning. And we think this particular theme or allocation will should suffice to ensure the portfolio delivers very strong growth in the subsequent year to come by. Now, market capitalization allocation is a outcome of how are we thinking on the sector positioning rather than thinking on market cap point of view. So obviously the shift has happened from, you know, from a large mid-ish portfolio to, you know, so when you think from a point of view, 75 or three-fourths of the portfolio was a larger mid-cap cumulatively. The number is similar now, but a marginal tail towards large cap. And we think some of the business in this new portfolio, have very, very wide competitive modes. Their cash flows are less cyclical, and they are also relatively mispriced compared to the growth that they offer. Uh, Importantly, it will also enable us to weather the uncertainty that we might foresee, given the fact that the earning growth on a broader scale, you will see relatively difficult time period as we proceed into H2 as well. Because please remember, barring a couple of sectors, we have seen, and whatever feedback that we have picked up from the ground, the growth has been lower than most market estimates. The small cap allocation has moved up because I said it's a clearly bottom-up approach. We have identified specific small cap stories that that don't even looks very attractive after valuation correction, but also offer a 25% plus growth for the next 2 3 years. We think the market obviously will price those assets appropriately once the earnings reflect and multiple expansion compounds the returns. So this is where the conviction, also remains, where the mid cap is in a sweet spot. Large cap is to obviously offer stability in the portfolio, and the small caps, essentially will drive, very strong growth, and essentially will get re-rated over the next couple of 3 years. And we also want to give you a broader perspective on another philosophy. We want to size position inversely proportional to volatility and directly proportional to earning visibility. Because what's happening is also when you look at the again when you just do when I do a reflection of the calendar 25, or when a lot of investors look at the calendar 25, most companies, I would go on to say 75% of the companies, even 80%, have actually delivered lower than what most people would have anticipated. More importantly, in a receding growth outlook, the bottom up picking obviously comes at the forefront. And that's why in a receding growth outlook coupled with lower liquidity, all the more, this kind of positioning will help on how to think about businesses going forward. So we think, rebalancing will allow active management rebalancing will allow a fair mix of large, mid, small caps, and rebalancing will allow what kind of growth that we are thinking at a reasonable valuation. And we are not completely, knocking off the good and clean thought process. Every company that we have seen in the portfolio that has come through, obviously has an underlying theme of, strong growth with very, very, very able and strong governance. So that's on the, and now coming to the portfolio attributes. So we think portfolio attributes, the numbers don't lie, right? The portfolio is clearly focused on the fundamentals. All the strategy, is focused on where the numbers will drive through. So we think the growth in FI, from when we look at 2 3 year view, FY 25 to 28, uh, the growth will be 20% plus for the portfolio. 25 to 27 is a 17% growth, again 1.6, 1.7 times of the benchmark. But if you think about the 3 year view, which is 25 28, we will be clearly 2 times the benchmark, because we think 25 to 28, the BSE 500 or the mid cap will only deliver 10 to 11% growth. So, and that's nothing to do with businesses going through a difficult cycle, but also to do with the operating margins in some of the names, sitting at record high levels. And I said in the beginning, right, a lot of commodities have driven a first half earning growth. So when you think about it, when we are sitting in FY 26, almost nearing to an end, the commodity base metals have gone up tremendously across the basket, which means FY 27 you will see a good pressure on the earnings because of operating margins sitting at a reasonable 3 year high in FY 25. So we are staring at moderation in growth in some pockets, earnings particularly getting challenged because of margin sort of coming off. And third and most important is selective growth being being offered in the market. So our focus on investing in a portfolio that offers all three of these will be the clear focus going forward. And we think from a longer term point of view, the PEG for the portfolio of 1.3 times, valuations obviously are very attractive for the portfolio level as a whole. But a ROE of 500 basis point ahead of the benchmark is a very, very critical sort of important element that we would like to sort of present here as well. Now, some signs of the improvement have started to witness in the last 1 to 3 months time frame, and we think that will only accelerate going forward as we proceed into FY 27. Please bear in mind our strong belief continues that earning growth will be very, very limited to few pockets, and that's exactly the big message out here is growth. We will focus on where the growth is. We will make it a balanced portfolio across the market buckets, and we will ensure the four pillars that we obviously have highlighted about: bottom up investing, approach of investing, value and growth arbitrage, inflection points, and the new age businesses. So with that, the three message that I left with you, I will sort of now comment my sort of discussion on the portfolio.